In our daily lives, financial markets are actually everywhere. You may notice that when companies around you want to expand production, they raise funds through loans or by issuing stocks. When elders in your family deposit their savings in a bank, they receive stable interest income. These seemingly ordinary activities all rely on the functioning of financial markets. For ASEAN countries, financial markets act like a powerful engine that continuously drives regional economic development. They connect the suppliers and demanders of funds, enabling capital to flow efficiently and supporting both enterprise growth and national development. In this lesson, we will explore the concept, structure, and important functions of financial markets in ASEAN countries to understand how this economic engine operates. This lesson covers three main areas. 1. Concept of financial markets. 2. Main components of financial markets. 3. Functions of financial markets in ASEAN countries. Financial markets refer to venues or mechanisms where the suppliers and demanders of funds conduct financing and transactions through financial instruments. Simply put, they are trading market for capital. Individuals or institutions with surplus funds, suppliers, can lend or invest their funds here, while those who need funds, demanders, can obtain them. The link between the two sides is formed by various financial instruments. These financial instruments act like bridges for capital transactions. Examples include stocks, bonds, certificates of deposit, and commercial papers, all of which serve as carriers of financial transactions. In ASEAN countries, financial market activities are very common. For example, farmers in Thailand deposit their income from selling crops into banks and receive interest through certificates of deposit, which represents the supply of funds. Malaysian companies issue bonds to raise funds for factory expansion, which represents the demand for funds. All of these are financial market trading activities, demonstrating the core function of financial markets in connecting supply and demand. One, money market. It mainly handles short-term financing, typically with maturities of less than 1 year. It functions like a short-term capital transfer station, addressing temporary funding needs of market participants. Singapore's money market is one of the most active and mature in ASEAN, attracting many companies from the region to raise funds. In 2023, a Vietnamese electronics company faced short-term funding pressure due to the need to purchase a large batch of raw materials. It issued a 6-month commercial paper in Singapore's money market and successfully raised $30 million. This allowed the company to pay for the raw materials on time and maintain smooth production. Such short-term financing is flexible and efficient, helping companies resolve urgent funding needs quickly. 2. Capital market. It mainly handles long-term financing with maturities of more than 1 year. It provides stable funding for long-term corporate development or major national projects. It includes 2 core segments, the stock market and the bond market. The Kuala Lumpur Stock Exchange in Malaysia is an important capital market platform in ASEAN, attracting many companies from the region to raise funds. In 2024, a logistics company from the Philippines planned to build a cross-border logistics hub covering multiple ASEAN countries and required substantial long-term funding. It chose to list on the Kuala Lumpur Stock Exchange and raised 250 million Malaysian ringgit through stock issuance, providing strong support for the project. Besides enterprises, governments also raise funds through capital markets. For example, the Thai government issued 10-year government bonds to finance the construction of a north-south expressway, raising 50 billion Thai baht. These funds will support infrastructure development over the next decade. 3. Foreign exchange market. It is dedicated to currency exchange between different countries and serves as an essential pathway for international trade and cross-border investment. ASEAN countries engage in frequent trade with one another. In 2023, intra-ASEAN trade reached $1.2 trillion. Such a large volume of trade relies heavily on the foreign exchange market. When companies settle trade transactions, they must exchange currencies through the foreign exchange market because different countries use different currencies. For example, an Indonesian exporter selling palm oil to Singapore receives payment in SGD. However, workers' wages and raw materials in Indonesia must be paid in IDR. Therefore, the exporter must convert SGD into IDR in the foreign exchange market to support domestic operations and ensure smooth capital flow across currency systems. 1. Promoting capital flow. The most fundamental function of financial markets is to build an efficient bridge between fund suppliers and demanders, allowing capital to flow from where it is abundant to where it is needed. In 2023, SMEs in ASEAN obtained a total of $85 billion in financing through financial markets. These funds acted like timely rain, helping companies overcome financial constraints. About 70% of the funds were used for technological upgrades and production expansion. Some companies introduced advanced equipment, while others developed new product lines. This significantly boosted enterprise growth, employment, and economic development. 2. Optimizing resource allocation. Financial markets act like an intelligent conductor, guiding funds toward efficient and promising sectors to ensure optimal resource allocation. Singapore's financial market excels in this area. With its mature mechanisms and sharp market judgment, it channels large amounts of capital into green energy projects across ASEAN. In 2024 alone, Singapore's financial market provided $12 billion in financing for Vietnam's wind power projects and Malaysia's solar energy projects. These investments accelerated the development of clean energy industries, aligned with global environmental trends, fostered new sources of economic growth for ASEAN countries, and enabled a more efficient allocation of resources. 3. Diversifying investment risks. In financial markets, investors can reduce the risks associated with single investments by diversifying their portfolios, following the principle of not putting all eggs in one basket. In 2024, many Thai investors adopted this strategy. They allocated 30% of their funds to the stock market to benefit from corporate growth, 40% to the bond market for stable interest income, and 30% to the money market to maintain liquidity of funds. This diversification ensured that even if one market experienced volatility, investments in other markets could offset the impact, effectively reducing overall risk and protecting investors' interests. In this lesson, we systematically learned the concept of financial markets, which are venues or mechanisms where fund suppliers and demanders conduct transactions through financial instruments. We explored their main components, including the money market for short-term financing, the capital market for long-term financing, stocks and bonds, and the foreign exchange market for currency exchange. We also examined their three major functions in ASEAN countries: promoting capital financing and ensuring the rational flow of funds, optimizing resource allocation by guiding funds toward more efficient sectors, and diversifying investment risks to protect investors' interests. It can be said that financial markets are a crucial pillar of economic development in ASEAN countries. Their healthy operation affects enterprise survival, industrial upgrading, and overall economic vitality. Understanding how financial markets work helps us better grasp the logic behind economic phenomena and lays a foundation for future participation in economic activities.